On, so 22nd of September, of course, so you can see that the meeting itself, on the 21st, you can see there's the 1800 hours, and you see what happened to the short-term rate. We actually got the 1 month look dropping down. We got the 1 month look dropping down, not up. Well, the reason why that happened, of course, was because it was either 75 or 100. So on the basis that it was 75, of course, there had to be some adjustment taking the 100 out of the equation, hence the reason why we saw some bullish upside on equities in the early stages. If you've got a forecast of 50 to 100 and it's, 75 to 100 and it's 75, equities will go up. It doesn't mean equities are bullish, but equities will go up because there's a relief rally based on the fact that it's not 100. And that's what happened here. This dropped down because the possibility of the 100 is now off the table. Make sense? So that's pretty straightforward. Now, one of the things that you've got to be mindful of going forward, though, is this idea of the terminal rate. And when you're looking at the terminal rate, of course, you're starting to move the needle out towards 2023s, possibly even as long as 2024s. And you want to see whether they're still ramping up the 2023s and the 2024s. You can see that the 2023-2024 actually did continue. This is the March 23. And actually what happened on the data, you can see that March 23 went up as the front end went down. Do you see that? Do you see that response? March went up as the front end went down. Take a look at 2024. Now, obviously, 2024 is a daily indicator. There's not any trade takes place in December 24 contract just yet, so it has to be looked at on a daily basis. So it doesn't give us a lot of insight, but it gives us an idea about what's happening. If we look at Z23, a very similar pattern. You see that from the data, the terminal rate actually went up. The terminal rate, or what the Fed calls the neutral rate, was higher. Okay, so based on the neutral rate going higher, and that was kind of in play all the way through till about 6 o'clock this morning. Yes? So if you were trading this, how would this behave in terms of an equity release? How would you expect to see equities trading? Well, if we go back to the headline and then the detail, we can start to understand a couple of things. So we knew that coming into the Fed itself, the forecast was for 75 to 100, correct? Everybody happy with that? There was nobody forecasting 50. So obviously what we can then say is, well, if it comes in at, because everybody's forecasting 75 to 100, what is the actual median forecast? Well, let's just, for argument's sake, it's 85. Everybody happy with that? It's 85. Now, on the basis that we have two scenarios then, 75 is going to be bullish equities because 85 has been priced in. 100 is going to be bearish equities because 85 is priced in, right? So 85 is median, but median basically means that's what's priced in the marketplace, correct? If the 100 was not priced in the marketplace, the median kind of estimate would have been 75. Right on the numbers, right? In which case 75 is priced in, 75 is the median, 75 comes up, nothing changes. Does this make perfect sense? Yes or no? I'm trying to curious to know if we're all happy enough, if we're all agreeing with this, if we're all delighted to acknowledge that this is effectively what's happening. Now, obviously, a lot of the devil is in the detail on these things, so we've got to be looking at it and saying, okay, well, what am I thinking? Well, obviously, the first thing that we've got to remember is that 75 is never going to be bullish equity. So when I say bullish equity, it's a relief equity, right? It's not so much bullish, it's relief. But it's still bearish because it's still a hot print, right? Still very, very hot. Still not exactly going to be giving everybody a QE type experience on equities anytime soon, right? So the data comes out, and what we're now looking at is, what's the detail? Well, the detail, of course, starts coming out through the press conference, for example. We start looking at the actual numbers, and obviously the detail is what they would call the neutral rate. And the neutral rate is obviously what we've just been analysing. One to 2 years ahead of the narrative. 1 to 2 years ahead of the narrative, yeah? So what did we get? Well, of course, we got 75 on the data. So the first thing is, the data release itself is expected to be negative. Why? Because equities had been on a relatively strong uptick. So we'd been selling equities the day before, remember? And then we had a bit of an uptick yesterday. Selling equities into the data would have made a lot of sense because it was always going to be 75 or 100. But obviously, if it comes in at 75, there might have been a little bit of upside, but there wasn't. But 75 is still hot. So 75 is still a hot print. It's not like we're saying 75 is definitely bullish equities, but it's bullish equities for a relief rally just on the basis that it's not 100. If they did 75 and they dropped the neutral rate, this would be very bullish equities. Very bullish equities. Because what you would see is that 75 is on the underside of the forecasts, and the drop in the neutral rate would have given us a very, very strong case to say that they've got things under control and we can see a slowdown in the process. So what are we kind of expecting? Because equities had been on a rally, we were already relatively highly priced in equities. So the first thing that happens, of course, is they hit 75 basis points. And obviously, because they hit 75 basis points, and because 75 basis points is a hot print, the first thing that happens is generally you'll see maybe a bit of a spike to the upside, but generally a big market sell-off. But how much of a market sell-off? Well, it's 75 basis points. It's not as bad as everybody thinks. So what's going to happen is there's going to be people starting to bid into this sell-off. Could have been 100 after all, right? Could have been 100. So everybody's going to bid back into the sell-off, and everybody's going to say, I think that's a reasonable proposition to take it back to where we are. Because remember, 75 is already fully priced in, right? So if 75 is priced in, we should at least be able to get back to that same price. 75 is already priced in. Now the challenge is, the detail starts getting looked at. And what the detail tells us is that the neutral rate is actually a lot higher than even had been expected. We saw that just from the previous chart. The neutral rate actually went from 407 basis points, and that was in December 2023, and it went up to 435 basis points. In other words, the neutral rate actually added an extra 25 basis point hike in there somewhere. An extra 25 basis point hike. So now that you've seen that neutral rate starting to pick up a bid again, you see that neutral rate starting to catch a bid after the data, literally going into the US cash close, you're saying to yourself, wait a second. That's not a good sign. That is not a healthy looking situation that I'm looking at here. And obviously you're going to be looking at that neutral rate and saying, look, neutral rate 1 to 2 years ahead is now an extra 25 basis points higher. And that's now very bearish. So not only did we get 75 basis points, but they added the extra 100 basis points because of the neutral rate, right? So in effect, we ended up with about 100 basis points, didn't we? You may say, how did we end up with 100 basis points? Because they just took it off the front and they put it on the back. In other words, they just pushed it out a little bit. Now that's probably the correct thing to do, but we still ended up with 100 basis points. So obviously, based on the fact that we still ended up with 100 basis points in reality, we started to see the top line and we started to see the selling coming in when people started to really get into the detail behind this. And they thought this is now basically a 100 basis point move. We've now got, in essence, 100 basis points to try and price into the markets. And 100 basis points must be below this price, surely to goodness. Agreed? So if this was pricing in 75 basis points or 85 basis points and a neutral rate, which was 25 basis points less than it was, we've effectively got an extra, an extra 20 odd basis points to price into this market, which is why when I go back up to the highs, it became a very, very strong sellable proposition. And when you look at equities, that's effectively what happened on the data, wasn't it? So when you look at equities, that's exactly how it played out. The data came out, we got the instant sell-off because it is a hot print. The buyers looked at that and says, well, you know what, I think that's biddable. I think that's a very, very reasonable price. Everything looks okay. But then the detail comes out. And obviously they've just bought a lot of stocks. They've just bought into this level 2. They think it's 75s. Everything looks reasonable. We've got obviously the pre-market, origin right there. And then you start looking at that and saying, wait a second. The December's way off. December is way off in here. And when you look at the overall shape of this, and you start trying to figure out what the December market is doing, and you start saying, well, what about the December markets when we look at the Fed, when you look at the Fed itself, and you start saying, what is the December markets doing? Well, there's a couple of things we can obviously start recognizing. Number one, we can look at the spreads. Yeah? We can obviously look at the spreads. We can start identifying some of the spread narratives in here. And as we zoom in, of course, as I said, this is an hourly chart. So if we look at the spreads on this, the spread is the 2-year minus the front end month. The spread actually managed to steepen massively at that stage. You see that? The spread actually steepened really, really, really heavily. So you're starting to say, well, wait a second, how did that start to shape up in terms of that equity, perhaps that equity move itself? Well, put it on your charts and have a look for yourself and see what it does. US 2-year yield minus 100 minus, obviously in brackets, the ZQ contract 1. Now what you're doing is you're now looking at the 2-year spreads against the shape of equities. And obviously when you start to recognize that that's the case, you start recognizing some of the impactors that are starting to go on in the marketplace. As the spread rallies, of course, as the spread spikes, you're starting to say, we are way above this as a rate. We're way above this as a rate. And again, even this morning, you started to see the spread spiking. And again, you're thinking to yourself, wait a second, this cannot be right. This cannot be right. Now, obviously, it did give back a little bit. You can see it did trade back down a little bit on a net basis. But obviously, again, you start to recognize that these are useful pieces of information for equities. They are negatively correlated. This curve is negatively correlated. The steeper this curve is, the higher the neutral rate is. The steeper this curve is, the higher the neutral rate is. And the higher the neutral rate is, effectively, the lower equities may start trading. Make sense? Now, how can we use that on a chart like a 1-minute screen? Well, you simply do the spread from the 1s to the 2s. If I use that on a 1-minute chart basis here, and we simply ask the question, well, how does that look on the screens? You can see it is a very strong negative correlation. You can see, for example, as we started to top out on the spreads here, the spread started to give us these level 2s. Equities were still falling. We were able to pick up some low prices into these equity lows, and we started to see a bit of a buy-side reversal. As we traded into the low price here, you can see that the spread actually turned around, and that gave you a possibility of a top edge sell. And you can see that obviously running into the top edge sells, coming back out, you can see we got big volume aggregations, and it allowed you to start selling the big volume aggregation. Into the bottom edge, we started to see big volume aggregation, and you started to see a systems buy trade. And again, that was on a divergent aggregation, systems buy trade, very nice rally to the upside. No divergence on this occasion for the top edge sell. So there was no systems sell trade, and these triggers are systems buys or sells against the curve itself. Systems buys or sells against the curve itself. So it is something to pay attention to, isn't it? It is something you can pay attention to. It is something you can look at and say, I kind of get it. I kind of understand it. I kind of see what I'm trying to see here. And obviously, if you can understand that, then life becomes a little bit easier because you're starting to understand the macro content of the charts, aren't you? You're starting to understand the macro content. Now, obviously, if you don't want to use the Fed funds futures because on a lower time frame it doesn't really make an awful lot of good reading, it is possible just to use the US 1-year yield against the US 2-year yields. Why? Because when you get an acceleration like this, you're going to get an acceleration right through the curve. It's not going to be a bump in the curve. It's going to be a uniform linear acceleration. That makes sense? So in other words, we can use any part of the curve to give us that information. So obviously, if you're wanting to use yields, you can use the 1s and the 2s, because that's obviously a very heavily quoted yield is between the 1s and the 2s. And you can obviously do it as a positive correlation or a negative correlation. This is now done as a positive correlation. Can you see what happens to the positive correlation here, guys? Take a look. So you saw into the, you can see as a positive correlation that this yield makes an awful lot of sense. So you see, for example, at 8 o'clock this morning, the correlation is telling us that we're getting a flattener coming in here. So we're getting a flattener coming in here. So you're thinking to yourself this morning, okay, well, that's bullish equities if that's now starting to flatten out a little bit. I like that. I like that storyline to buy equities into. Bearing in mind that this comes back to, I suppose, David's question about the drivers concept. If we know that this is what's driving our markets today, this morning, surely this must be one of our main focuses this morning. It's not about the sentiment. It's not about the VIX. It's not about these types of elements. It's really about the interest rates, isn't it? It's really a story of interest rates that's driving the markets at this stage. And obviously what happens is, you can see we get a divergence in here, buy side bottom edge, nice rip to the upside. Divergence in here for a possible couple of buy side swings. Massive divergence creeping back in against that sell trade. As the data kind of catches up, we start seeing some other data coming in. Massive sell trade for equities there. Bottom edge, very obvious buy trade coming back in. And then a diverging top edge here for the sell. You can see that quite clear. A diverging top edge here for a sell. You can see that quite clear. And that's where we currently are in the matrix just now. The drivers are now known to us. And this is the challenge that, you know, the indicator builders, the program builders like Cuba and, you know, Argo, this is where these types of programs have problems because the driver changes. You understand? So unless you've got an adaptive system that can change which market is the most heavily weighted driver, then of course what might happen is you'll end up getting a lot of value buys that aren't actually value buys against the main one. Against the main one. And that's where we start to see the challenges of system buys and sells, because we've got to be able to ask the question. So what I would say to traders like Cuba and Argo who are looking at a more of a systematic type process of trading is to have the ability to say, switch it off for the time being until we get back to normal market conditions. Trying to keep it forced into trading when it's not the right drivers. In other words, if you sit down at your desk as a systems trader and you say, well, today it's not about the systems, it's not about the value lines, it's not about relative value, it's about fundamentals. Well, why would you try and trade a relative value system when it's about fundamentals? You wouldn't, would you? You'd try and trade a fundamental system based on the fundamentals. You would change the nature of your drivers. And, you know, that might be okay for somebody like Cuba and Argo to do that, but you as traders should be doing that as well, shouldn't you? You as traders would be doing exactly the same thing, because you'd be saying, well, value isn't the be and end all of today's market, because I've got something even bigger that's driving my storyline. And that something bigger has to be taken into consideration when I look at these things. So what you find is that you end up with these parallel shifts in value that value traders like R-squared traders like Argo and Cuba are, ends up buying a lot during a down move, ends up selling a lot during an up move. And that obviously can pose massive challenges, because if you get a bad price, you're going to get stopped out, and you're going to get stopped out, and you're going to get stopped out, you're going to get stopped out. Instead of being able to take $100 swings, $500 swings, $1,000 swings, you're literally taking $50 swings. And so get stops to break even, because you're not going to be able to hold on to that trade, because it's a buy on a downtrend. It's a parallel shifting market. And the only things that parallel shift the markets, guys, literally, are fundamentals. Technicals don't parallel shift the markets. Fundamentals parallel shift the markets, because there's been a paradigm shift in the model. If there's a paradigm shift in the model has changed. If the model's changed and you're using the old model, guess what's going to happen, Cuba? It's going to be wrong. You're going to buy on the way down, you're going to sell on the way up of a parallel shift, and you're going to be in real trouble, right? You're going to be in real trouble. So you've got to have a switch. But isn't this exactly what's true of every single trader in the room? It's not about Cuba and Argo. It's about every single trader in the room having the ability to switch off from that value line, or those value lines, and allow the fundamental driver to dominate the proceedings until that settles. And then you can switch it back on again, because everything goes back to anchoring again. All the processes go back to the same thing. So this becomes quite an important feature, doesn't it? This is really the driver that you want to be using. Correct? This is the driver you want to be using. The short-term interest rates, because the short-term interest rates is the value for everything at the moment. Short-term interest rates is the value for everything at the moment, but it won't be again next week. It'll be back to normal next week. Everybody will kind of have forgotten and priced in what the Fed's doing. Everybody will now be looking about what the Fed's about to start doing on the next raise, or the next hold, or the next whatever. So everybody starts to move beyond the prior move once it's priced in. Beyond the prior move. So this is very, very important. So what we've got in the charts here is the 1 year minus the 2 year yield. Positive correlation, 1 year minus 2 year yield. So when we see this, this is why we covered this in classroom yesterday. I was hoping that people would pay attention to this, because this was a very, very, very strong storyline. The fact that the short term dropped and the long term actually rallied was one of those kind of trades where you say there's going to be a reason for people to buy in short term, but then when they see that longer term rally at the back end of the curve, they're going to be saying, oh my God, this isn't good. This is not good. So whilst they might have gained perhaps about 15 basis points, and that's why the price rallied, they gave back 25, 30 basis points, and that's why the price then dropped. Make sense, everybody, guys? Everybody get that? Everybody understand that? I know it's a little bit complicated for people to get their heads around, but it's not that complicated, guys. It's not that complicated. Anyway, how did my sell on bonds do, guys? I gave a shout out for sell side bonds earlier. And again, guess what price, guys? Guess what price? 144s. Anybody not heard me saying that you should be selling anytime we go above 144? Is there anybody that missed me calling sell side 144s for the last 5 days? Is there anybody that missed me calling 144 sells for the last 5 days? Well, 144 sells just went to 141s, guys. We just made $3,000, and we've been calling it for 4 days, 5 days, 6 days. Remember? Damn right you remember. Remember we came into this area a few weeks ago? Sell side 144 plus, sell side 144 plus, sell side 144 plus. Remember all these sells. Remember. All these sells that we kept telling you. If it goes above 144, smash it. If it goes above 144, smash it. If you don't remember, just check back on the tweets, guys. Been calling it for weeks. Literally. Been calling it for weeks. 144 sell side. Well, we've just got all the way back down to 141 again. And you can't tell that we didn't tell you so, guys. We can't say you didn't know. Because you did know. Tell But we didn't tell you so, guys. We can't say you didn't know. Because you did know. A bunch of miseries. Looking at this in terms of a DVO1, you can see what happened into the top edges. Well, hopefully you can see what happened into the top edges. You can see that the spread beautifully bubbled blue, green, red, top edge sell. And then it bubbled reverse here for a buy back up into the top edge. And then it bubbled blue, green, red, another sell. Top edge bubbling away beautifully. 144 sell side. Called this morning for you. Called last week for you. Selling 144. Called yesterday, in fact. Sell side 144 yesterday as well. And it doesn't get any better than that. Doesn't get much better than that, guys. Crazy good trade. Parallel shifting curve as well. Bubble starting to appear in here now as well. So a nice opportunity to start banking your monies at 144s. And that's a pretty good trade, guys. I'm quite proud of that one. Because we've been really, really touting that 144 level aggressively. Congratulations, guys, if you're on it. That's lunch, Yomi. Now, oil prices, they've given us a few challenges today. Not for bonds, of course, that's been supportive of the bond move. But oil prices have certainly given us a few challenges. I want to touch on that yen trade this afternoon as well, by the way, guys, in class. Because there's a lot of really interesting technicals when it comes down to benchmarking this morning's Bank of Japan intervention. If you didn't know, coming into the US session, the Bank of Japan intervened in the forex markets. One would imagine that they intervened with a nod from the Federal Reserve. They usually don't act alone on these matters. And the BOJ intervened in the Japanese yen, and obviously that's why the Japanese yen gave us a strong pop to the upside, which is why it's not being included as a value line just now. So the Bank of Japan intervened. We had this Japanese yen pop this morning at 9 o'clock. We talked about this buy trade here. It did very well, thank you very much, on the halfback trade. And it's basically a very, very, very strong story. So obviously if you were sell-side bonds, one of the things you wouldn't have been looking at was obviously the Japanese yen, right? Sell-side bonds, look at the Japanese yen. You'd be saying, wait a second, I can't trade this because the Japanese yen's going up. What? What? Do you see where the problem is for people? The Japanese yen's not going up because of bloody bonds. It's going up because there was a Bank of Japan intervention. Do you get it? You stop using it as a value line. It's a fundamental driver in the yen. It stops having value. Stop using it as value. And it just takes a little bit of reading the news and understanding this stuff, guys. Come on. It's not that difficult. It was plastered all over your news this morning. So you saw it. And as soon as you saw it, you'd say, well, wait a second, that's now a fundamental driver. So you take it off your screens. If Kuba was using it, Argo was using it for an algorithm, they would take it off. They would switch that part of the algorithm out of the markets, right? Because it doesn't make any sense. It doesn't make any sense. And obviously with this rally here, there's no way you would have been able to sell bonds. Because you'd have been saying, but the Japanese yen's really well bid. No shit, Sherlock. The Bank of Japan just bought billions. Of course it's going to be well bid. What the hell is it going to do with the bond? Nothing. Exactly. Get over it and sell bonds. There's a challenge to that. Because at some stage, the carry trade hedge kicks in. The carry trade hedge kicks in because if we've got a big sell on bonds, what's happening to US yields? US yields are exploding. What's happening to the carry trade? The carry trade becomes more and more and more and more appealing. And if I can now sell Japanese yen to fund dollar purchases at a very, very high level, I can now take full advantage of the carry trade by getting short yen. And then the yen becomes an incredibly high probability sell trade behind the bond selling off because the carry trade's just exploded in favor of short yen. and now you're getting a great price for your short yen. There is nothing like it, guys. There's nothing like it. You've got a brilliant carry trade hedge narrative developing right there. Makes a lot of sense now, doesn't it? Or it should make a lot of sense, guys. It really should start to make an awful lot of sense.